LiteFinance, the
Hello, it's Monday, November 20th, and it is time to start the market forecast for this week, where apart from the calendar, I'll be discussing the fundamental factors that are currently driving the market of gold. Okay, so without further delay, let's begin with the macro events schedule. So on Monday, we will have inflation on producers' side from Germany. On Tuesday, inflation CPI from Canada. On Wednesday, US core durable goods orders, initial jobless claims, crude oil inventories, and FOMC meeting minutes. On Thursday, we will get PMIs from Europe's major economies from both sectors, manufacturing and services. But the second part of the day might be less volatile since there is a holiday in the US and Japan as well. On Friday, we will get a GDP from Germany, PMIs from the US, but there will be early stock market close. So again, the second part of the day might be less volatile. That would be it in terms of the calendar. Now let's move on to fundamental analysis. So gold is viewed as a tool for hedging inflation risk, but its best performance is recorded when CPI trends down. The US economy is weak, and the Fed plans to switch from tightening to monetary stimulus. A similar microenvironment is currently forming, so the XAU-USD inspires optimism. However, things can make a U-turn at any moment. We are witnessing the most significant inflation fall not accompanied by a recession in history. The previous occurrences always resulted in an economic downturn, making the Fed unpack monetary stimulus, weakening the dollar, and letting gold shine. Central banks usually act collectively as consumer prices slow down worldwide. The derivatives market puts odds on policy easing everywhere, not only in the US. While major currencies are weakening and losing confidence, gold is shining. However, treasury yields won't probably fall as much as expected if the Fed achieves a soft landing. The consensus forecast for 10-year yields is 3.75% as of the end of 2024. Nevertheless, Barclays believes that the US ability to avoid a recession and its huge government debt will hardly drop bond yields below 4.25%. At the same time, economic stability is the USD's main trump. The US exclusivity factor backs up the USD index when GDP outside the US leaves much to be desired. If Treasury yields and the USD remain stable, gold will hardly update record highs. Still, they always talk about a soft landing in the market before plunging into a recession, and then the hope dies and GDP shrinks. So, the best scenario for gold is a sharp worsening of US macro statistics, which will eventually result in an economic downturn. In that scenario, unwinding monetary stimulus will be likelier, bond yields will drop, and the USD will seriously weaken. The precious metal will have a chance to rise to $2,050 and $2,100 an ounce. If the Fed achieves a soft landing by getting inflation back to 2% without triggering a recession, the dollar and yields will drop as much as expected. Dollar will likely consolidate in a range between 1900 and 2025 an ounce. Finally, the least desired scenario for the XAU-USD is a comeback of high inflation in the US. If prices reach a new peak, as they did in 1970, the Fed will have to resume tightening and gold will collapse to 1800 an ounce. And that will be all from my side for today. Thank you guys for watching, and goodbye.